In this video, we're going to discuss the types of student loans that might be available to you if you apply to college in the United States. So you might be able to obtain loans from the federal government, from the state in which you live, or from the college itself, which would be called institutional loans, or a private lender, something like Wells Fargo or some other bank. So I want to talk about federal loans first, and there are a number of different types. It basically falls into two categories of federal loans. You have need-based and you have non-need-based. When I say need-based, I'm talking about your expected family contribution that is calculated by the federal government when you fill out your FAFSA form. So if your EFC is very low, then the federal government will say, well, look, this is a student with high financial need, and you might be eligible for a Perkins loan. So a Perkins loan is available to undergrad students, graduate students, professional students, so if you're in law school or so forth, but it's only available to students with extreme financial need. So if you have a very low EFC or circumstances where you have a high financial need, you might be able to obtain a Perkins loan. It generally has favorable interest rates, and it has subsidized interest. And subsidized interest basically means that the government will pay the interest for you while you're in school or while the loan is being deferred or on grace period or so forth. So basically when the interest is subsidized, that means the loan is accruing interest, but the government is paying it for you. Now once you've graduated and beyond the grace period, beyond any deferment or whatever, at that point, if the loan is still outstanding, you'd be responsible for the interest yourself. Now there's also a second type of subsidized loan called a direct subsidized loan. Direct subsidized loans are available only to undergraduates. So if you're a graduate student, unfortunately, you're not going to be able to get a direct subsidized loan. But don't fear, because there are unsubsidized loans, and these are awarded on a non-need basis. So it doesn't have to be a situation where you have a really low EFC to get a loan to attend college. You can get a direct unsubsidized loan, and direct unsubsidized loans are available to undergraduate, graduate, professional students, basically any type of student pretty much can get an unsubsidized loan. And unsubsidized just means that from the minute you borrow this money, you take out this loan, it begins accruing interest, and the government is not going to pay that interest for you. It's not subsidized. So if you borrow $5,000, the day you borrow that, it starts accruing interest, and you can pay that at the end of the year, or you can just let it be capitalized to the loan itself and pay it later when you graduate. Also, you can get a Direct Plus loan, and these are also non-need based. But Direct Plus loans, so if you're an undergraduate student, these are available to your parents. So the parents of an undergraduate student or a graduate student or professional student, it's another type of unsubsidized loan, but this is a little different. Right, so with unsubsidized loans, there's actually a cap on the amount that you can take out of unsubsidized loans in any given year and lifetime and so forth. But with the Direct Plus loan, you could basically borrow up to the cost of attendance of the school minus any financial aid that you're receiving. But you have to go through a credit check. Now, the credit check is not unbelievably difficult, basically just looking to see if you have adverse credit or serious problems. And even if you do have some kind of issue with credit, you might be able to talk to a financial aid administrator and be able to qualify for a Direct Plus loan anyways. So it's a good option. It has a higher interest rate than like the Perkins loans and so forth, but it might be a little more attractive than getting a private loan or something, which we'll discuss. Also, you can consolidate your loans. You can get a direct consolidation loan where you combine all your federal loans into one loan, and then you have a single servicer, so you're not having to deal with multiple loan servicers after you graduate or something like that. Also, your state, you should check and see if the state you live in provides any kind of student loans. If they do, don't just assume that they will be great rates or so forth. You should look into and see what the rate is and so forth. And I have got some caveats that you can look into in a minute. Well, also, the college itself, your institution, by institution I mean your university, your college might provide loans of its own, right? Not through the federal government or the state or anything, but they just might have that university itself in certain cases might give loans. You should check. Obviously, this is on a university basis. Some universities might have a really great interest rate, and this would be something that you should really look at. Other ones might have an interest rate that's like the amount of a credit card or something. So you really want to read the fine print and that goes for state loans, it goes for institutional loans, and also private loans. Private loans are just loans that you go and get from a bank, like I said, like Wells Fargo or Bank of America. It's just any kind of bank or institution. We're talking not the state, not a college, not the federal government. There's some private organization that is making a loan. And now you want to think about some really important things. Particularly with state loans, institutional loans, and private loans, you need to be a little bit more careful than with the federal government. The federal government loans have very, very favorable terms for you, and they'll work with you, and there are a lot of options. If you're unable to pay, you can get a deferment, forbearance, but with state, institutional, or private loans, you want to check the fine print. You want to see what is the interest rate you're going to be paying. And you compare that to a plus loan, right? Because with the plus loans, you could borrow up to that cost of attendance minus financial aid, generally speaking. So if you're paying a much higher rate for a private, basically to a private lender, then you might say, hey, look, is there some way I can get a plus loan instead of this? So look at the interest rate. Also look at is the interest rate fixed or variable, right? If it's a variable interest rate and then interest rates go up or something changes, that could be really problematic for you. And also look at what are the origination fees. What are the fees you get charged for taking out this loan? And also, who is the borrower? Is the borrower your parent? Is the borrower you, the student, and you need a cosigner or what? So you should check into the details of that. But for more information, particularly about the federal student loans, you can go to studentaid.ed.gov, and they've got a lot of great information.